This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to the channel. Today's video is an update on my portfolio and, more importantly, a look at what I'm planning to buy next. If you've been following my Blossom account, you've probably noticed my holdings have shifted a bit lately. Well, that's mainly because my Wealthsimple margin joint account finally got approved. So, I've been busy moving funds over and doing some rebalancing along the way. But before we dive in, a quick disclaimer. I'm just sharing my personal buying plan. So please take your own situation into account and don't just mirror it blindly. Alright, let's start by looking at what I'm holding right now. If you check out the chart, you'll see that the core of my portfolio is still very much concentrated in QD, SD, and CD. Together, they make up over 40% of my total assets, and they've really been the foundation of everything I do. SD and CD cover the US and Canadian markets, and they're basically enhanced defensive products. They're relatively diversified, pretty stable, and they provide a really decent dividend yield, which makes them perfect as my anchor positions. QD is a bit more on the aggressive side. It's packed with high growth potential stocks, so while the upside is great, it does tend to drop harder during pullbacks, so you've definitely got to keep an eye on that volatility. Besides those, I've also kept a mix of sector-specific ETFs like QQQY for Nasdaq Tech, INTI for international exposure, Bank for Canadian banks, GLCL for gold miners, UTS for utilities, and Oily for Canadian energy. I set it up this way to make sure I have geographic and sector diversification for when the market gets shaky. Plus, I'm careful not to put all my eggs in one basket with a single fund company. That way, even if one company decides to cut its distribution, my overall monthly income stays relatively stable. One of the biggest factors in this rebalancing was the margin requirement. You see, newer funds like QD, SD, and CD usually have a 50% requirement, which means the amount you can borrow against them is a bit limited. But older, more established funds like Bank and UTS only have a 30% requirement. This is huge. It means I can use less of my own capital to borrow more, allowing me to scale up the total size of the portfolio while actually lowering the risk of a margin call. For example, if you have $100,000 in principal, a fund with a 50% requirement lets you reach a total position of $150,000. But with a 30% requirement, you can reach about $240,000. It's just way more efficient, as long as the portfolio is diversified enough to keep the risk under control. So, through this adjustment, the portfolio is now much more balanced and ready for whatever the market throws at it. So, where do we go from here? Even though things have been a bit bumpy lately, the overall indices haven't actually dropped that much. I mean, the S&P 500 is only down about 6% from its high, and the Nasdaq is down around 9%. To me, this feels like a pretty mild pullback, so for this stage, I'm sticking to conservative margin buys. I'm mainly looking at Bank, UTS, and QQQY. These are all evolved funds, and they're known for having very stable distribution. That's super important to me because I want the distribution to cover my living expenses and help pay down the margin interest. Since that interest is a fixed cost, having stable cash flow makes everything much more predictable. And again, the fact that their margin requirement is only 30% is a huge plus. Specifically for QQQY, it tracks the Nasdaq 100 Tech Index but without any internal leverage, so it's actually safer than those ETFs with 25% leverage. If the price pulls back to 24 Canadian dollars, the yield would be around 16%, which is fantastic value and fits perfectly with my goal of seeking stable returns. But if the market decides to take a deeper dive, let's say the S&P 500 drops more than 10%, that's when I'll start gradually scaling into HHIS. Now, this ETF has an annual yield over 30%, but it's also highly concentrated in growth stocks and carries 25% internal leverage. That means when the market falls, it falls hard. That's exactly why I want to wait for a significant pullback before jumping in. It gives me a much better margin of safety. There are other concentrated US tech ETFs out there like QD and BIGI that also have great yields, but their margin requirement is 50%. HHIS, because it's so popular, only has a 30% requirement, which lets me move more capital with less principal. It's just more efficient for the current environment. As a long-term investor, I don't really sweat the short-term dips. I'm more worried about whether a fund can actually bounce back. On that front, I have the most confidence in QD. It actually has the lowest dividend payout of the bunch and the lowest covered call overlay, only about 20%. This means it leaves a lot more room for the NAV to grow during a recovery. Compare that to HHIS, which has a 30% to 40% covered call coverage, it should still be pretty solid. But for BIGI, which uses a 50% at-the-money call strategy, honestly, I would say it would be a challenge to maintain its NAV long-term. Now, what if things get really ugly? If the S&P 500 crashes more than 20%, I'd consider selling off oily and GLCL and rotating that money straight into HHIS. See, while energy and gold miners are great hedges in normal times, they can really lag behind during a sharp market rebound. Cutting them loose frees up cash for assets that have much higher recovery potential. At that level of market panic, I'd also look at split share funds, specifically an all-in-one product like CLSA. These funds are very high leverage, and if you buy them when the margin of safety is huge, like during a market crash, the returns on the rebound can be massive. Of course, this is the highest risk move, so you have to be extremely disciplined with your timing and position size. Basically, my core strategy is a step-by-step approach based on the depth of the dip. On a small dip, I go for low-margin conservative ETFs like Bank and QQQY. On a correction, I add HHIS, and in a total crash, I pivot to high-leverage recovery plays. It's all about starting conservative and getting more aggressive as the opportunity grows. One last reminder at the end of the video. This is just my personal plan and how I'm thinking about the market. Things change fast, and everyone's risk tolerance is different, especially when you're dealing with margin. I'm not trying to hype up margin usage here, so I won't get into the nitty-gritty of the math or daily monitoring. If you're curious, definitely check out Wealthsimple's official rules or talk to a professional advisor. Alright, that's it for today. I really hope this update and my step-by-step strategy gave you some useful ideas. If you found this helpful, please hit that like button, leave a comment with your thoughts, and don't forget to subscribe so you don't miss the next update. Thanks for watching, and I'll see you in the next one.